Hello and welcome to the latest episode of the Retirement Cafe podcast. If you're a regular listener to the podcast, firstly, thank you. And thank you for joining me again this week. And secondly, you will be probably aware that the podcast is sponsored by the Timelineapp. Each week I give a brief explanation of the Timelineapp software and how it helps financial planners like me bring your retirement journey to life and answer your big retirement income questions. Now, the Timelineapp really comes into its own at this time of high market volatility. So I'm delighted to welcome to the show today founder and chief CEO, in fact, of Timelineapp, Abraham Okusanya. Now, I've known Abraham for a number of years and watched in admiration as he continued to bring cutting-edge technologies to the financial advisory market. He's become a published author and has been hosting the highly successful Science of Retirement conference. Abraham is here today to help us understand the current stock market performance as a result of the coronavirus and put it into context of historical events over the past 100-odd years. Thanks for joining me, Abraham.
Hi, Justin. How are you?
Yeah, good. Thanks for taking some time out on our bank holiday Easter Monday. Take a break from all the other stuff that's going on.
Yeah, it's a pleasure indeed, and I have to say, a break from the usual routine of watching TV, babysitting children, going in the garden. There isn't really much you can do, my friend. So
I suppose running an IT company, a technology company, it's pretty good. You can all work from remotely, probably, can you?
Absolutely, yeah. So this in terms of the working, this hasn't been a massive change for us because everyone just works from home. So
yeah, good stuff. So Abraham, now I've you and I have been working on this stuff for quite some time, and actually, I mean, the Timelineapp was perfect for. I mean, it's horrendous to say, isn't it, that that it's all about back testing data and seeing what's gone on previous market declines, stock market declines, that is. But this is in essence why you built the software, isn't it?
Indeed, absolutely. I mean, let's not, downplay all the pain and suffering going out there in the world. That's obviously, serious things that we need to be mindful of. But as far as, financial aspect of things is concerned, I feel like over the last 5 years or so, we've been on this journey, essentially working with financial planners and saying to them, we've got to stress test our client's financial plan for some of this worst case scenario because it is just part and parcel of planning. We're hoping for the best, but we're planning for the worst. And this is what Timeline has always done. And I feel incredibly proud of financial planners out there who's been using, our software, because we're saying to them, you've already planned for this. You've already stress tested your client financial plans for this. So unless you've built, changes into the plan under this current market condition, you shouldn't have to change anything because this is all sort of within the range of historical scenarios that we've modeled, planned, and prepared for.
Yeah. So let's just go back a step here, Abraham, for the listeners who may not have advisors who use your software yet. And what was the problem in essence that you were trying to solve when you came up with this idea?
Oh, thank you for that. So essentially, the problem we're trying to solve is very simple. Traditionally in financial planning and generally when people think about the investment returns, and they project into the future, people tend to think in a deterministic way or in a straight line projection kind of way. So, unfortunately, we do this within this profession within the financial planning profession, but the wider financial industry, where people say, well, if I have £100,000 portfolio and I assume that investment grows at 6% a year, that should land me. I should be able to draw, an income of, £6,000 from that portfolio, and that portfolio would never run out of money. But that seems like a reasonable sort of assumption. But of course, the real world is just completely different. That assumptions bears no semblance with the real world, and the real world is that we get this cycle of bull and bear markets. A bull market is when the equity market, the stock market, just continues to rise for an incredibly long period of time. The last 10 years is a perfect example of that. Since the great financial crisis, equities just went on, and it seemed like you could do nothing wrong.
Yeah.
But as with all things, all good things, they do come to an end. And so now we have this bear market that has started. So equities declined, or shares have declined. The value of shares have declined by more than 20%. So we're in that bear market period, But of course, this is all part and parcel of the stock market. If you look at the history of the stock market over the last 400 years that it's existed, and not only in this country, but in the US and globally, you find this cycle of ups and downs. And so our idea has always been that, well, we have to stress test. We have to build plans not based on simple assumption of 6% a year growth, or whatever the straight line assumption you have. We have to reckon with reality, take the actual behavior of the stock market and run multiple scenarios, not just one. We need to run multiple scenarios. Some of those scenarios will be good. Some of those scenarios will be bad. Ultimately, we need to have a plan for the bad scenarios. This is what we refer to technically in the industry as sequence of return risk. This idea that the order of return is almost more important, or certainly as important, as the actual return. If you get poor return in the early phase of retirement, that has a disproportionate effect on the overall outcome. So we built Timeline to help financial planners run multiple scenarios and build a plan that would work even in the worst of times.
Yeah. So this is coming back to your analogy of your client with £100,000 in their retirement savings pot, whether that's a pension, whether that's ISAs, whether that's, they've got that invested. And this idea that because the returns don't come in a straight line, but historically stock markets have rewarded investors well. In the US and the UK, over the long term, I think your data goes back, I think that most of your data starts at about 1926. And that showed an annualized return north of 10%, isn't it? On
correct. Yeah.
An equity portfolio.
Yes. Yeah, that's correct.
But of course, there have been some periods where the market's not returned anything for years and years and years and years, and then all of a sudden given amazing returns which is in essence rewarded the patient and penalized the impatient.
Yeah, absolutely. So if you live long enough, and you stayed invested, the capital market always rewards you, right? This has been, there are very, very few examples where it hasn't, So if you think about, people always talk about, the the example in Russia, for instance, where assets get confiscated by the communists, and the simple answer to that is, well, have a global diversification. Don't just invest in one country and ignore the rest of the world. But yeah, the fundamental point, you're absolutely right, that is that over the longer term, and we can define longer term typically as 10 years or more, equities tend to reward patient investors. But we can't just ignore all of the bad periods and not taking them into account, because that is the pain that you have to go through to get this reward. And we have several examples in the UK recent and long history of markets declining significantly. You have the bear market of 1973 and 1974, so where, UK equities, if you had £100 invested in UK equities at the beginning of that bear market, the value of your money declined so much, by as much as 67%, got you down to 33 pounds from £100, and then that was the trough, and then the bear market resumed, and you made all of the money that you lost on paper back, and a lot more. So that is just part and parcel of long-term investing, unfortunately.
Yeah. And this, of course, is the key value that I get from using your software with clients, is that what you need to model, of course, is what you expect someone's behavior to be. Because there probably is, and I've never nailed you down on this, but there probably is the kind of economic best portfolio based on historical returns. You could, because we've got the data, and you've especially got the data, you could probably look back and go, this would have been, if I had the benefit of, of a crystal ball, this would have been the best portfolio to invest in. Of course, what that doesn't allow for is human behavior to come into play at the same time. Because even, let's say that you said to me, I know we're far too young for this, but let's say that I was 73, I was 3 actually, so I know you're much younger than me, but let's say you had been advising me as a 3-year-old and said, this is the time to get in, 73, 74. I know it's only down 67%. but you want to go and put some more money in, Justin. And of course, we'd have never had to work again, because of course the stock market rewarded us perfectly. But of course, the reality is, I can imagine in 1963, 73, 74, in 3-day weeks, oil crisis, horrendous conditions, power cuts, etc. Looking at the history books, there's no way that I would have been putting more money into the stock market at that moment in time. So, human behavior doesn't align itself, does it, to the exact right portfolio?
Absolutely. And, Justin, I've never shied away from this, that point. As a matter of fact, this goes back to the reason why, in spite of all of the pressures that we've had, or demand, so they call it, to make Timeline available to, to ordinary investor, and we think it can help, but we still do value the incredible behavioral, coaching and guidance that a financial advisor brings to the table. You're absolutely right that when we have panics like this, the human mind is filled with fear. And we can't make, as humans, we can't make rational decisions in the midst of fear. There is just no room for fact-based decision making in our minds when our minds are filled by fear. And so I have always believed that these times is when a financial advisor, a caring behavioral financial advisor or financial counselor, call it, hand their cape, because they can have a conversation with the client, try as much as possible to empathize with the pain and with the fear that the client is feeling, and offer some guidance, in times like this. So, I absolutely accept that. And I just, to my mind, having data, having visualization, and more importantly, as you said, the stories behind the data. One of the things that we provide to advisors is this long graph that shows not just the graph, but actually the different events that the capital markets have experienced over the last 100 years or so. So the story behind the data makes a lot of difference. So I have always believed that you need the empathy of a financial planner to help clients through decision making at this very difficult time. I don't believe that having data and evidence diminishes that in any way. I think it strengthens it.
Yeah. So Abraham, I mean, obviously you've talked about financial planning, and my model. I'm very keen on making sure that people have got a regular stream of their income to pay their bills, some nice cash reserves, and I model make sure they've always got, they can always pay the bills for 5 years without touching their portfolio in the event of a market decline. Now, there's lots of different models, and that's not saying what's right or wrong, because that appears to be right for my clients. But the classic question at the moment is, right in the middle of this, so we're on Easter Monday. I think it's the 13th we're recording.
Yeah.
Is it different this time?
No. I mean, you can say that it's always different. So in the sense that the causes of financial market decline isn't always the same. So, if you cast your mind back to the great financial crisis of 2008 or 2007, 8, 9, I don't know how you want to put it, 2008. That was precipitated by some failings in the financial system. So you might call, in the banking system, you might call that a top to bottom decline, where there is something's gone horribly wrong within our financial service system, and that ended up feeding through to the general economy, to then have impact on real lives of people going to work every day and haven't done anything wrong, right? So that was a particular example. 2000, the tech bubble, the so-called tech bubble of 2000. Was caused by exceptional greed within the technology sector. There was another decline that you can put around that time. What do you call it? Remind me. This American event. The plane crash.
Yeah, the 9/11.
9/11 was around the same time, and the market declined around that time. That was caused by a terrorist attack. So, and right now, we have a global pandemic. So we have health crisis, public health crisis, that has led to shutting down of economic activities, and that is now essentially feeding its way through into financial markets. Something is always going to be the cause of this financial crisis. There is no way in my mind to predict with any degree of certainty how and when market declines will happen. What I do know and what I do see from history is that they just do. And I have faith. I have incredible faith in our ability as humans, in our in our ingenuity, call it that, as humans, which is expressed through art and science, but also in capitalism. And so everything I see right now, and we're tracking this decline in the financial markets and see how the market is recovering or otherwise, all we see is that this is not different. Unfortunately, this is not different. And I don't want to get into whether or not we've got the wherewithal as a race to overcome this. I believe that we have. I believe that there is tons and tons of work going on behind the scene by government, by scientists, by our medical profession, that I have absolute faith that we will overcome this. And when we do, the capital market will resume its upward permanent trajectory of growth. That's what I believe. That's what I see in history, in the numbers. I think it would be completely irrational to think otherwise. I mean, can I turn this on you?
Yeah.
If you like. All right. I was doing a thought process the other day, and I said to myself, Justin, what if we're wrong this time?
Yeah.
What if we don't beat this?
Yeah. I've asked myself the same question, and I think it's interesting. Let's say, and I've thought about this. Let's say there was a permanent decline and we've never seen a permanent decline in the equity in the capital markets, as we've talked about, and which is why having the evidence that you bring to the table with Timelineapp is so useful. Because let me just frame this for a second. The way I use your software is that let's say a client comes to me with their existing retirement portfolio, and they're saying, Justin, we're entering into retirement in this year, next year, whatever. In the near future, we need, let's say they're in their classic kind of early 60s. And the number one concern generally is to make sure that they don't run out of money. And the number two thing is that they haven't got quite at their handle on, but the number two real thing is, if it's a couple, we know, and your software helps us do this, we know through the Office of National Statistics how long an average couple will last for. And we know that a couple around 60 years of old have quite easily, one of them still going to be around 30 years later. So we've got a 30-year retirement in front of somebody. And of course, the big number in that 30-year retirement is generally inflation. We know that prices the money they'll spend in the supermarket this week will be significantly different in 10 years' time, and in 20 years' time, and in 30 years' time. So we've got to make sure that we're not ravaged by inflation, that the assets don't just disappear, which is kind of one of the reasons we don't leave it in the bank, because we know that cash returns don't generally exceed inflation. Why should they? So then we come back to this fundamental. Then we get into the equity markets. We globally diversify. You keep the costs as low as possible. And then you look at this, you back test a portfolio and you say, okay, let's look at the portfolio you've got at the moment, and we put it into your software and we see what it would have done historically. No prediction, but this is what it would have done historically. Then we may look at a portfolio that I've designed and I've designed it, of course, with the benefit of the data.
Mm-hmm.
And I again go, well, this is the success rate of my portfolio. We'll be able to just go, well, one's better than the other. And if theirs is better than mine, I want to know what's going on. but of course, and of course, your software has gone through all these market declines. The 20s depression, World War II. 70, as I say, the 70s crash, 87 crash, 2000s, 9/11 and dot-coms and credit crunch, banking crisis, so we've modeled all that, and we've said that the markets have continually moved on. And there's a fundamental reason, of course, why the markets have moved on, is that governments don't want equities to fail because the whole system collapses. The whole system collapses if equities fail, because if we lose faith in our banking system, our insurance company system, and in fact, even the exchange of value of our money, the pound in our pocket is no longer worth a pound in our pocket. If we lose faith in all of those things, then the whole system does implode. Absolutely. So the whole system is built to try and make sure that that doesn't happen.
Yes.
So yes, it could do, but if the whole system collapses, to be honest, the least of your problems at this point is going to be your stock market portfolio, because your house is going to be worth diddly squat, and you'll be more concerned about how many vegetables you can grow in the garden and whether you've got a big boat and a gun.
Absolutely, and you touch, and I hope that people will see that. I'm not underplaying the pain and the suffering that we have out there, and the incredible challenge that we have, to overcome this. But the fundamental point you touched on it, absolutely, you're absolutely spot on, is that it's not, to my mind, worth thinking about this question: what if we don't overcome this? Well, if we don't overcome this, we'll all be dead.
Yeah.
And your portfolio will be the last thing you worry about.
Yeah,
there will be far much more issues to worry about. And I think you are absolutely dead spot on about the government stepping in to stop financial system from failing. This is what they've always done, to varying degrees. And you might actually argue that some of the discussions going on in the US right now is the Fed, the Federal Bank, the Federal Reserve Bank, basically saying they're going to step in and provide buffers to all of these companies, especially the airline sector, and including companies who have maybe not behaved responsibly. They haven't kept enough cash. They paid dividends that they shouldn't have paid, or they paid their bosses too much, and all this stuff.
Yeah.
But for me, every time this happens, I sort of think to myself, well, I'll take equity risk any day. Why? Because central bankers and governments just don't want the capital market system, the financial system, to fail, and they will always do whatever they can to prop it up. Is it fair? I don't know. I don't necessarily think so, that it's completely fair. No. But I would rather be on the side of as an owner of equity and an owner of a tiny stake in capitalism than not. This is the situation.
I also think that there's an element that I'm a little chap in Mudderford in Christchurch. We're not a big firm. We're trying to do our best, and you have to work on what you've got, what you understand. And then also just go, okay, so that's that bit. And then what else can I do? What is it that I can do as a human being in my community, with the people I work with, or even in the wider community? And that's what we've been looking at as a company. This is a crisis, and that causes huge anguish, and we know, it's amazing what our health workers are doing.
Yeah.
And there's amazing suffering going on with so many families are going to be touched. I know I think yesterday, over 10,000 people lost their lives to this.
Yeah.
Reported to be lost their lives in the UK. Amazing. And then I think, okay, is there charity donations we can make? What can we do in our communities to help out and do something? At least then you're not feeling that you're a total, I don't know what the right word, but I'm going to say eunuch, that you're that you're not without any opportunity to do any kind of help into this world. Forget the clients' portfolios of equities are temporarily declined. I do believe, like you, that they will permanently advance once we come through all this. But if there is human suffering or there's human things that you can do in your community now, and especially as advisors, and we know we have a lot of advisors listening to this, if there's things that they can do in their communities through money skills, through donations, to whatever it may be, that's at least some kind of feeling that you're actually doing some kind of contribution to this crazy world that we're currently living in.
Absolutely. And that's where we should stop this conversation, isn't it? You're dead spot on. I want to throw a tiny little thought into that, though. I actually believe that, as an investor, you are doing this because you have faith in the future. I have never understood the importance of the work that our grocery delivery driver does until a week ago. This chap pulled up, and delivered our groceries. And of course, as an investor in the capital market, I own a tiny, insignificant stake in Tesco and Sainsbury's and all the other public companies out there, But I said to this guy afterwards, I said to him, thank you for keeping us and our family going at this time. As an investor in the capital market, you are supporting these companies who are keeping us going. And, I know this is a little bit self-righteous to say, but by not pulling your money out and pulling the support that this company has at these times, you are doing some good, and this is the difference in my mind between an investor and a speculator. An investor stays through the thick and thin with the great companies of the world who are doing good work. Yeah, not perfect work. We can always criticize and make things better. Yeah. But, so, and I would say to all investors out there, not the speculators, thank you for keeping our economy going. We've never needed this more, than at this point. Yeah, so thank you.
So true. Great. Well, Abraham, thanks very much for joining me. It's been a thoroughly nice way to spend my bank holiday afternoon, because it's always great to chat to you. And I know your enthusiasm for helping us planners do a great job and have good outcomes for our clients, which is what we really care about. So once again, thanks for taking the time.
No, thank you for the work you do, Justin. I'm a big fan of your work and of the work that you do with clients. I think it's incredibly important at these times to help people put things in perspective and to save families, families' financial future from errors that might come at this time. So keep up the good work, my friend. Thank you.
So until next time, this is Justin King helping you feel more informed in your retirement.